The S&P 500 is playing a dangerous game, flirting with all-time highs as if it has forgotten the harsh lessons of the recent past. A significant rally in 2023 is propping up the spirits, seemingly recovering losses from the tumultuous year of 2022. However, beneath the surface, there's a tale of two markets, one where some companies showcase robust fundamentals, and others ride the wave of valuation expansion. Market darlings like Nvidia are riding the wave of the AI revolution, experiencing substantial market cap growth. The fusion of artificial intelligence with various industries is propelling certain stocks to stratospheric heights. Nvidia, at the forefront of this revolution, is reaping the rewards, but the question lingers: is this growth sustainable, or are we standing on the precipice of another tech bubble? The shift in market sentiment is palpable, transitioning from fear to extreme greed. Investors seem to have cast aside caution, embracing a euphoria that often precedes a fall. It's a precarious situation, reminiscent of previous market cycles that ended in tears. Looking ahead to 2024, the market pins its hopes on a soft landing orchestrated by Jerome Powell, accompanied by potential rate cuts. Optimism about lower interest rates is fueling a rebound in risk assets. But is this optimism well-founded, or are we underestimating the challenges that lie ahead? Interest rates and the 7 to 10-year Treasury bond ETF are under scrutiny. The question looms: will interest rates go lower? In a world where uncertainty reigns supreme, the bond market becomes a battleground of expectations. The delicate balance between inflation and economic growth will sway the fortunes of investors. Yet, amidst the financial juggling, elements of chaos disrupt the landscape. Trust in media is declining, eroding the foundation of information dissemination. The rise of deep fakes, propelled by advanced artificial intelligence, introduces a new dimension of uncertainty. Verifying news sources becomes a Herculean task in an environment where truth is elusive. Financial challenges echo through the corridors of concern, with fears of Ponzi financing haunting the U.S. finances. The warning bells toll, signaling that America's debt is on a perilous path, and the sustainability of this trajectory is in question. As the specter of economic instability looms, the need for prudence in financial management becomes ever more urgent. Delinquency rates on commercial banks paint a deceptive picture, hovering near all-time lows. Yet, beneath the surface, there are murmurs of potential problems in the banking sector when loans come due. The calm facade may be masking the storm brewing in the financial sector. Gold, the perennial indicator of economic anxiety, is approaching all-time highs. The shiny metal, often considered a haven in times of uncertainty, seems to be signaling concerns about central banks losing control. Are we witnessing a flight to safety, or is this the canary in the coal mine warning of impending financial turbulence? In navigating this complex landscape, investment strategy becomes paramount. A bottom-up approach to investing in exceptional businesses is championed. The emphasis is on a long-term, multi-year, and multi-decade investment journey. It's a strategic dance, where the willingness to buy more of a stock during a sell-off is driven by a preference for slow, thoughtful investing. Volatility is accepted as an intrinsic part of the market conditions. Extreme greed is acknowledged as a prevalent sentiment, creating an environment ripe for miscalculations. Yet, within this turbulence, a view emerges: buying opportunities during market downturns become the silver lining. It's a contrarian approach, swimming against the current of market exuberance. As we peer into the crystal ball for the outlook of 2024, caution prevails for some of the largest components of the S&P 500. The recognition of potential challenges and the complex forces at play underscores the need for a measured and vigilant approach. The market, like a tempestuous sea, may present opportunities, but it also conceals hidden reefs and treacherous waters. In conclusion, the current state of the market is a precarious balancing act. The S&P 500 dances on the edge of all-time highs, propelled by a rally that seeks to erase the scars of the past. Market darlings, particularly those in the realm of artificial intelligence, enjoy substantial growth, but the sustainability of this ascent is questionable. The shift in sentiment from fear to extreme greed raises alarms, as history has shown that such euphoria often precedes a fall. Looking ahead to 2024, optimism about a soft landing and potential rate cuts permeates the market, but the underlying challenges cannot be ignored. Interest rates, the bond market, and the 7 to 10-year Treasury bond ETF become battlegrounds of uncertainty, while elements of chaos, such as declining trust in media and the rise of deep fakes, introduce new dimensions of risk. Financial challenges, including concerns about Ponzi financing and the sustainability of America's debt, cast shadows over the economic landscape. Gold, in its ascent to all-time highs, may be signaling a broader unease about central banks losing control. In response, investment strategies advocate for a bottom-up approach, a focus on long-term journeys, and a willingness to weather market downturns. Volatility is accepted as a reality, and extreme greed is recognized as a potential pitfall. The outlook for 2024 is approached with caution, acknowledging the potential challenges and forces at play. In this tumultuous sea of market dynamics, investors are advised to tread carefully, eyes wide open to the risks that lie beneath the surface. Please consider liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.